All right, let's get right into it. The markets are flashing red, Bitcoin is taking a serious tumble, and pretty much everyone is wondering, is this just a dip or is it the start of something much, much bigger? We're going to dig into the data, look at the plumbing of the financial system, and figure out what is really going on.
So this is the question, right? It's all over social media. It's in every group chat. Is this it? Is the big one here? You can literally feel the fear in the air. But we're going to try and cut through all that noise, look at the actual mechanics behind the scenes, and get a clearer picture of what's happening.
Okay, first things first. We got to talk about Bitcoin's dive. What was the trigger for all this chaos? And, can we separate the pure raw panic from what might actually be a more structured, even planned event happening in the background? And here it is. This was the moment that sent alarm bells ringing everywhere. Bitcoin smashed through that huge psychological barrier of $100,000. And look, it's not just a number, right? For so many investors, that was a critical line in the sand. It triggered a massive wave of automated selling and, of course, a whole lot of very human fear.
But here's the thing, was this move just a total random fluke? Well, not if you look at the on-chain data. And that's just the public ledger of every transaction on the Bitcoin blockchain. The clues here are actually pointing to something that wasn't a black swan event, but a rational, observable pattern.
Now, this is where it gets really interesting. What the analysis shows is that it's not the new investors who are panic selling. Nope. It's the long-term holders, the OGs, who are systematically cashing in their chips. See, this isn't random chaos. This is what's known as a distribution phase. It's planned.
And, well, we've definitely seen this movie before. This kind of sell-off from the old guard, it happens in waves. And when you see the current dip in context with these previous dates, it starts to look less like a one-off catastrophe and more like just another part of the cycle.
Okay, so let's zoom out. We need to step away from just crypto for a second, because if you really want to understand what's going on, you have to understand the plumbing of the entire global financial system. And at the end of the day, it all comes down to the US dollar. A lot of people don't even realize this, but there are actually two dollar systems working at the same time. You've got the onshore system inside the US, the one the Fed controls, but then you have this other beast, the massive, unregulated offshore system, sometimes called the euro dollar system. It's basically a global shadow banking network that operates in US dollars, but completely outside of America's reach. The amount of money sloshing around in there is just immense, and when there's tension between these two systems, that's what really drives global liquidity.
Which brings us to a term you've probably seen thrown around with a lot of panic lately, repo crisis. It sounds terrifying, doesn't it? But what does it actually mean? Let's pull back the curtain and demystify the repo market.
So at its core, a repo transaction is just a super short-term loan that's backed by collateral. And this is the key. It is not the Fed firing up the money printer like they did with QE. It's just a bank needing cash for a little bit, so it swaps some assets like Treasury bills with the Fed and promises to buy them right back. It's just a plumbing tool to keep the pipes from getting clogged, not a massive bailout.
So here's the play-by-play. It's pretty simple. A bank hands over some really high-quality collateral, like US bonds. The Fed gives them cash. Then, in a day, or maybe a week, the whole thing just reverses. The bank gets its bonds back, and the Fed gets its cash back, plus a tiny bit of interest. See, it's just an in-and-out deal. It's designed to keep the whole system running nice and smooth.
And this chart right here, well, it really puts everything into perspective. That tiny little bar on the left, that's the stress that people are freaking out about right now. Now, look at that monster spike on the right from the actual repo crisis back in 2019. I mean, come on, they're not even in the same ballpark. What we have now is a little bit of tension, sure, but it's nothing like a systemic breakdown.
So if the repo market isn't blowing up, then what is going on? Well, let's stop debunking fears for a minute and start uncovering the incredibly powerful, positive forces for liquidity that are actually building up right now just beneath the surface.
Okay, I want you to think of this next idea as a gigantic battery. A battery that's been fully charged with cash, just sitting there, waiting to be plugged into the market. And this battery, it's actually the US Treasury's own bank account.
This account is called the Treasury General Account, or TGA. It's been filled up recently, and now it's holding close to $1 trillion. Now, the really important part is that this cash is currently sitting outside the regular banking system. So when the government starts spending that money, it gets injected directly into the economy, and that acts as a massive tailwind for liquidity.
And that leads us right into the second major positive force. The source material calls this one an unstoppable train, and for a very, very good reason. We're talking about US government spending.
Look, while there might have been a temporary little pause in just how fast the government is spending money, the underlying trend is undeniable. Fiscal spending is this huge, dominant force that just keeps pushing liquidity into the system, and it's set to continue, providing a powerful, ongoing support for the markets. All right, let's tie all of this together. On one side, you've got the short-term fear and the selling pressure, and on the other, you've got the underlying fundamentals of the market. So how do they really stack up against each other? First, let's just acknowledge what's in the air. The crypto fear and greed index is flashing extreme fear. And that just confirms what you're probably seeing and feeling yourself, right? The market is panicking. And that panic is driving a lot of short-term, emotional decisions.
This table basically sums up our entire conversation. Over on the left, you've got the temporary problems. The OGs taking profits, a strong dollar causing some issues, and just raw, unfiltered market panic. But then look at the right. Those are the powerful medium-term tailwinds, that unstoppable government spending, that trillion-dollar TGA battery ready to go, and the massive demand for U.S. debt.
So here's the bottom line. The crucial point is this. While the prices are scary and the fear is absolutely real, the underlying fundamental drivers of liquidity, they haven't changed one bit. The machinery working behind the scenes is still incredibly strong.
And that really leaves us with one final thought. When everyone else is reacting to the noise on the surface, understanding the market's plumbing, the stuff we just talked about, helps you see the real signals underneath. So the question isn't just about what the market will do next. The real question is, now that you know this, what are you going to pay attention to? Thanks for tuning in.